All right, investors, today we're going to be looking at Wheaton Precious Metals to try to figure out if it's a worthwhile investment, if it's worth buying it, especially in this environment that we're in at the moment, 2023, April 4th. I'm going to be looking at some numbers and talking a little bit about the company. Now, the company itself is a streamer, okay? It's a precious metal streamer. Now, for those of you who don't know what that is, it's basically kind of like a financing company for the precious metals sector. They will finance a project and then they'll just take some off the top or off the bottom, actually. They'll get paid first, and whatever's left over goes to the miner. That's miners, and like gold miner or silver miner or something. Although they invest in companies that not only mine silver and gold, but other metals as well. They renamed themselves from Silver Wheaton, I believe. And now they're called Wheaton Precious Metals. It's a very good company, well-run company. Before I even get started in the numbers here, I think it's an A+, like S-tier company in the precious metals. All right. So I've owned it before. I was familiar with it back like 10 years ago. I haven't really taken a very deep look at it as of recent, so I'm just going to do a numbers overview to try to figure out if what they're doing is in the right track and whether or not it's worth investing in the company. So I'm going to move my camera here on the right so I'm not that intrusive, okay? And this is today's performance. Okay, had a nice pop of up 1.67%. Obviously, it's going to trace the precious metal sector to a certain extent. It's going to move up with the whole sector if gold and silver are moving up, and it's probably going to go down with the whole sector if they're moving down. They're not dragged as drastically as other miners or other mining related companies because of the nature of their financing. I think of it as kind of like the bondholders of the precious metal sector. Okay, although it's not a very good analogy, but that's how I think of it. They move slower, and everything else, all the other miners are kind of like the call options of Wheaton Precious Metals type of streaming companies. So everything else is more volatile than Wheaton Precious Metals. This company's been around for a long time and has done a really good job of managing itself. If we look at the long-term charts, they look great. Look, this is the 5-year chart, up 144%. That's not too shabby. Even the max chart looking great. I mean, it's right now, I think it's above the 2011 highs. I think 2011 highs was something like 45. Now it's sitting at 50, so that's really impressive. 2011 was a big spike in the precious metals companies, and if it's higher than that now, that speaks a lot to the company's potential to go up in price. I'm going to list some of the positives first, and then I'll talk into a little bit of the negatives to try to figure out if this is a good investment for you or for me. Now I'm going to go into the income statements. I like to do quarterly, as you may know already, so I can get a little more definition into the numbers. It looks like the revenue has actually been pretty flat since 2016. There's been a substantial boost here in 2020-21, but now it's fading. The precious metals prices have been on a little bit of resurgence, a little resurge. So this number might go up. Maybe more deals will be made. Maybe more money will come in. We'll see. So I'm expecting next quarter actually the revenue to be higher. We'll have to wait and see. Other numbers, we're gonna skip about most of this. We're gonna go straight to net income, and it looks like they're earning quite a bit of money. I mean, so about 150 million per quarter, right? So what's that? 600 million a year or so. That's not bad. We'll see how that compares to the valuation of the company. Other numbers that I like to look at is shares outstanding. It looks like they have not diluted their shares as of recent. I expect a company like this to actually issue some shares in order to fund some of the new projects, right? Because they need money, And if they don't have enough money to fund, then they would sell shares in case there's a good deal. So expect something like that to happen out of a company like this, but they actually don't sell as much shares as you might expect. So you're not getting diluted along the way, but also that has negative effects too. And I'll talk about that in a minute. So it's not always best to just not dilute the shares. Sometimes diluting the shares is good. I may give you an example of a company that does that well and balances the act of issuing shares and increasing, dividends and things like that in the process later on. If you're interested, the company is called Realty Income, which I own. All right, so moving on to the statistics, you'll find out that the market cap is a little bit larger than the enterprise value, which would suggest that there's actually net cash in the company. However, when I scrolled down to the balance sheet, it was a bit confusing because, it said that there's net cash of 700 million, yet total debt is 2 billion. Oh, I'm sorry, 1.97 million. I'm not used to seeing debt that low. So basically they have no debt. But anyways, going into the financials, you can see that visualized. So actually the balance sheet, excuse me. We'll go to quarterly, and you can see that their cash position is up there. I mean, it's $700 million, and they've basically gotten rid of their debts. Current assets, total assets, 6.76 billion. Now that's not cash on hand. That's just assets. That means somebody else's liabilities to them. So that's not too bad. But it's kind of worrying that the assets, like if this was a if this was a bank, for example, you would want your assets to be actually larger than your market cap. So this is already a sign that the company is overvalued, which is where I'm going with this, as you may be able to tell. And yes, I realize that the company's always been overvalued since basically its inception, because of the model and the stability and all that. But that doesn't mean it's a reason to park your money there. So next, we're looking at total liabilities, which is only 42 million. It's nothing. Total debt, look at this. They have no debt. Right? I'm pretty sure you can see this, right? Okay, good. Total debt. They haven't had debt since 2020. They've paid it all out and they're chilling. I mean, this company is just rock solid, right? It's very conservative with its money management, or has become conservative. There's been a time where they've had more than a billion. They've had more than $1 billion worth of debt for some time before, like 2015, 2018. Those are really, really tough times for the mining sector, by the way. I remember those times. So total liability 6.76, just like total asset. Now, moving on here, things I want to talk about is their dividend. All right. Now, the whole point of holding a company like this is that you're going to be getting some cash back. I mean, if you were owner of the streaming company, right, the whole point of the streamer is to make an investment and then get regular incoming cash back. So that's kind of what you're looking for as an investor anyways, right? We're not necessarily like investing in a growth company, although they might be growing and their asset side might be growing, but we want some returns. And it's been I don't know how many years this company's been operating, for many, many years. And, it needs to be spitting some money out, but traditionally the company doesn't spit any money out. So let's take a look at the dividends tab here, see what we can find out. The dividend is 1.2%, which is actually higher than I normally see it. When I owned the company, the dividend was like 0.6%, and now ironically it's 60 cents, which is 1.2%. The payout ratio is 40.5, and dividend growth is 1.69. This is a list of the dividend issuance over the past, few years, all the way since 2013, and this is that in a graph. So it looks like the dividend is steadily growing. We had a dip here in 2014-15, understandably. Those were nightmare years for the precious metal sector. And now, it's been a steady growth, which kudos to them. It has not had an increase since 2021, August 2021. It's been flat, so at about 15 cents per quarter. So you can see that the dividend growth is about zero here for that time period. So I don't know how they calculate it. Maybe overall dividend growth is 1.69%. But either way, it's pretty low. Definitely lower than inflation, that's for sure. And 1.2% yield, guys, you know, I understand, the company is growing and all that, but 1.2% dividend is actually what it is right now. That's like 4 times lower than what you could get in a money market account at the moment. So if you had your cash parked in a money market account just at your brokerage, you'd be getting nearly 4 times more cash in a form of a dividend or interest payment per quarter. Actually, the interest payments on the brokerage accounts go monthly. So either way, 4 times. And with that, 1/4 of a dividend that you could be getting by owning Wheaton Precious Metals, you get all the volatility associated with the precious metals sector. Yes, it's doing well now. Yes, it could do well in the future. But even if they double, right? Even if since the payout ratio is about 40%, let's call it 50, let's double it, right? You'd still be getting less. You'd be getting, 3% yield at the most. And then the company would be tapped out. They would have to go in debt to pay you more than that. All right. So it's a weak dividend payer if that's what you're looking for. If you're looking for money back, this isn't going to be the company. This is more akin to like a growth company style investing without necessarily the growth associated with the tech sector or, some other startup. So I don't know the exact reason why somebody would be a long-term holder of this company. I guess even though it's an S-tier company in the mining sector, right? I guess if you're looking to have diversification, all right? If you're looking to have an exposure to the precious metals market and you're not enchanted by the big miners always going up and down and getting in trouble with debt and whatnot, and you're not enchanted, with the volatility of the actual metals or any kind of products associated with the metals themselves, then Wheaton Precious Metals might be a right choice. However, if you're just looking for a return on your money, parking there for 20 years, you're going to be losing to just keeping your money in your brokerage account. That's pretty embarrassing. So it just depends what you want. It just depends what you want. But the thing is, like, if you want optionality on the run up on the precious metals, there are other things you can buy, right? If you're expecting a spike, which is how the precious metals industry works, it doesn't work like a gradual climb. And if it does have a gradual climb now, it'd be, abnormal. You'd be better off buying options, on just the precious metals themselves, or buying one of those volatile silver or gold mining companies that are basically function like options, right? So they spike up because metals go up, and they have a short duration of time where they're profitable and they make a lot of money, and then they just drain money over time because the money is reinvested to make more money. And it's the equivalent of like the theta burn. If you buy a call option, over time the silver or gold mining company is going to decrease in value because they have to keep tapping investors for money to keep their operations going if they're not profitable. So it works kind of like an option. So there's other ways to play it. I don't think that Wheaton Precious Metals, if we look at the chart, right? If we look at Wheaton Precious Metals chart, you can see that you're not going to get a ton of play. I mean, look at the difference between the low. Okay, so $10, but in 2018, 16 and 50. I mean, yes, this is a huge, difference for a regular stock, but for a mining related stock, honestly, it's not that much. This is like really conservative, okay? So, I mean, some of these miners go from, you know, $1 to like $30 or something like that. So it's a little bit paradoxical, like a little contradictive, this company is a little bit of an oxymoron, right? Because you're looking for optionality on the precious metal sector, yet it's the safest thing that you can do. So it's kind of muting the whole effect of what you're trying to do. So for me, it's hard to own it. Like when I did own it for diversification reasons, it felt good owning it. Like I knew that I have a grade A, like, or S tier, S plus tier asset, but it didn't do much anything for me besides diversification, right? They would just sit there and spit out like 1% dividend per year, and you know, maybe go up in valuation, maybe go down in valuation. I know it's not gonna go bankrupt or anything like that at all. They've done well over the past managing their money, but it's also not doing anything for me either. You know, in a 0% interest rate world, it could perhaps serve some kind of a function, right? Besides the little diversification, like peace of mind that you get before you go to bed. But right now, I can't see it unless, I really don't know. Maybe if you have a good reason to own Wheaton Precious Metals, or you own Wheaton Precious Metals, I want to hear about it below. Just write a comment below, because I'm interested to know what the rationale is, because I'm struggling to find reasons to own it, even though it's such a great company, right? I just don't have the reasons. So let me know what you think below. Maybe because I do want to have some exposure to precious metals. I don't have any right now, so I'm looking for something, but I don't think Wheaton Precious Metals is the one. But if you own it, please, you know, write the rationale, or even if you thinking of owning it, write it down so you can help me out. All right, that's it. Peace out.